cycle. Number 1. What might stop financial statements showing a true and fair view? Remember that IFRS says that our financial statements need to be as accurate a reflection as possible of the true state of the financial position and financial performance of a business. So this is what we need to keep in mind. Let's have a look at which of these options are possible. Don't just choose any one as correct immediately, but what you can do is simply put a little ticker across next to it to indicate which are the options that you can consider. Hopefully only one stands out, otherwise you need to then compare the best options and choose the most correct. A. Changes in depreciation methods from year to year. If you choose to change your depreciation policy, for example, from using the straight line method to the reducing balance method, it's going to change the way in which you value your non-current assets. And as a result, you can't really compare one year to another accurately. And it also means that either this year or last year is not a true and fair view. And therefore, Number A is certainly an option for what would not show a true and fair view, so you can highlight that as a possibility. B. Changes in dividend policy. Dividend policy is something that you can actually change year on year. That simply means how much the directors and shareholders approve can be paid out as dividends as a percentage of the profits that are earned. Very often companies will decide to usually distribute approximately 50% and then keep the other 50% for expansion in the business. If, however, this changes, it just means that your figures on your financial statements will be different, but that is a true and fair view of what has actually happened. So B is not going to stop an accurate reflection. So B is not an option. C, the creation of a general reserve. When you create a general reserve, that simply means that you are moving money out of your retained earnings, which is a distributable reserve, and putting it in a general reserve, generally for expansion or something at a later stage. So in other words, you're deciding you don't want to distribute the money as dividends in the short term. Again, just like number B, this is not going to change or stop a true and fair view of the actual situation of the business. It simply means that you are changing the way in which you're deciding to allocate the funds. D. Inclusion of purchased goodwill in a statement of financial position. Remember that you can only include goodwill if you've actually paid for it or if somebody has paid for it, so that you have an objective valuation of that goodwill. In actual fact, if you are able to include purchased goodwill in a statement of financial position, it will give you a more true and fair view of the actual situation of the business. And therefore, if anything, number D is a better way of reflecting the financial position. So it certainly wouldn't stop a true and fair view. So it also is not a possibility. Therefore, the answer for number 1 is A. Let's have a look now at number 2. Which statement about the sales ledger control account is correct? First, identify what is a sales ledger control account and visualize it in your own mind so that you know what we are talking about. Remember that the sales ledger control account is one lump sum general ledger account which is drawn up as a summary of all my customer accounts as one bulk item. So in other words, if I look at all my individual sales ledger accounts and I take all those transactions and I lump them together into one sales control account, that is going to show my total trade receivables balance. In other words, the total amount that all my customers owe me all together. Over time, it would go up and down as you make sales, as goods are returned, and as payments are made. So that's what you need to keep in mind when you see sales ledger control account. So now let's have a look and see which options would be correct. It is to verify the total of the customer account balances in the sales ledger. Yes, this is definitely an option. The reason that we draw up the control account, remember, is for part of our verification process or our checking We want to see if perhaps any mistake has been made along the way in a similar way to the reason for why we draw up a trial balance. So A is a possibility. B, it is used to calculate the gross profit on sales. No. Remember that even though the word sales is in this title, sales ledger control account is actually your total trade receivables or your total of customer accounts. So it's not gross profit, it's not my total sales. B is not an option. C, it is used to calculate the total sales for the year. Again, this is not an option. Although sales would be included in my control account, I would also be including a number of other things like payments and returns. So my total sales would rather be reflected in the sales income account rather than in the control account. So no, C is not an option. D, it is used to reconcile the cash received from customers with the bank statement. Now, although cash received from customers will be included in the control account, to go and use that to try and reconcile with the bank statement would be very time consuming and wouldn't make a lot of sense. In fact, when we do our reconciliation, we'd much prefer to use the receipt side of the cash book to determine what cash we received from customers. And that's so therefore number D is also not an option, and my answer is going to be A. Let's now have a look at number 3. In which book of prime entry is the contra between the sales ledger control account and the purchases ledger control account recorded? What do we mean by contra between? That just means that we've got two sides to the transaction. So one side is using my sales control and the other side is my purchases control. In other words, I'm doing a transfer between these two accounts of my customers and my suppliers. In other words, I probably have a customer who is also a supplier, and I want to offset the amounts owed so that one payment can be made instead of two separate payments, one to my supplier and one back again from my supplier if I am the customer, for example. So let's have a look. Which is the book of prime entry? Remember, prime entry means we're looking for the journal, and you can actually see that here by the word journal in all of these options. Cash book is also a kind of journal, although in actual fact it is the cash ledger account, but it also does the function of a journal. So which journal am I going to use to record this? Remember that journals each have a primary function. The primary function of the cash book is to record cash transactions, cash receipts and cash payments. If I'm moving between my customer accounts and my supplier accounts, no cash is changing hands. A is not an option. B is the general journal. The general journal is used wherever another journal is not available to do the transaction that I want. In other words, I have not got a nice summary journal for this type of transaction. So a general journal can actually be used for just about any transaction as long as you don't have another journal. And yes, B is certainly an option in this case. So make a little note on the side, we'll come back to it, but that is definitely a possibility. C, a purchaser's journal. Purchaser's journal is used where we are buying something. So my accounts involved are both purchasers and my suppliers. In this case here, my accounts, yes, are suppliers, but customers are the other account, not purchasers. So therefore, purchaser's journal is not going to be suitable. And similarly, a sales journal is between my customer and my sales, whereas I'm looking for between my customer and my supplier. So that brings me back to B as being a suitable option for number 3. Number 4. A business omitted discounts allowed of $700 from its trial balance. During the year, a machine has been sold for cash of $500, but the only accounting entry made was a debit in the bank account. So, what is the balance on the suspense account before these errors are corrected? Now, Firstly, let's work out what is going to be wrong in my trial balance. If we omitted discounts allowed of $700, that means that I've got $700 too little on the debit side. So my credits will have $700 extra. Remember that my suspense account is going to be created to fill in the gap. So if I've got $700 credit extra, that means my suspense account would need $700 debit. So that's what we're going to start with. If you want, you could make a note of this on the side. Then I need to look at the next transaction. During the year, a machine had been sold for cash of $500, but we only did a debit in the bank account. So this $500 is telling me that my debits are bigger than my credits by $500, and therefore my suspense account would need to have a $500 credit. So these two accounts show a debit of $700 and a credit of $500 that would be in my suspense account. So the overall effect would be number A, a $200 debit in my suspense account. Let me just quickly revise that again because I know it can be a little bit confusing here. What is happening is that I've got $700 credit and $500 debit, too much. So my overall trial balance has got $200 on the credit side more than what is on the debit side. And to fill in that gap, I'm going to make a $200 debit in my suspense account. A is therefore going to be my answer for number 4. Let's now look at number 5. A business has a good reputation. The owner wishes to include goodwill in the financial statements. An accountant advises against it. Do you remember we discussed goodwill a little bit earlier? We need to make sure that our goodwill is actually paid for and it's got to be objective, and otherwise it's not a true and fair reflection. So, which accounting concept is the accountant applying? Because the accountant says, sorry, you can't do this. Yes, it has got a good reputation, but you can't just pop it in the financial statements. Why not? Well, A, business entity. What does that mean? A business entity concept is saying that we are going to keep the transactions of the owner and the business separate. In other words, this will be things like drawings, where you're going to record the transactions of the owner separately to those of the business. And so if the business pays the owner's telephone account, you would record it as drawings, not telephone. So that doesn't really apply in the scenario given. That is not a possibility. B, going concern. Going concern says that we are assuming that the business is going to carry on operating for the foreseeable future. Again, that does not relate to this situation that has been given to us. C, matching. Matching says we are trying to link the incomes and the expenses in a business with a particular financial year. In actual fact, IFRS actually refers to the accrual concept, which is saying that we're looking at when the transaction happens rather than when the cash changed hands. But that is linked to matching. But again, neither of those relate to the scenario here. D, prudence. Prudence says we are going to be a little bit more conservative. And although prudence is technically a GAAP concept, which is what we used to use in South Africa before we had IFRS coming in, it is what is going to apply in this situation. And we wouldn't really talk about prudence these days so much. I'd prefer to refer to the IFRS concept of a fair and accurate reflection. How are you going to value that reputation? It's very difficult to give it a fair and accurate reflection of what it's worth when we haven't actually paid for it. And so therefore, D is going to be your option. A sales ledger control account was prepared. An irrecoverable debt of $40 was omitted and a discount allowed of $68 was entered as 86. What was the effect of these errors on the closing balance of the sales ledger control account? Well, before I even look at those options, so I'm going to hide them so that they don't tempt you, what we want to do is we want to see what happened that shouldn't have been. So let's have a look before we look at the answers. Yes, you can see it's A over here, but I want to show you the workings and how we get there. If you had a bad debt of $40 that you forgot to put in, that means that you are going to be overstated by $40. You're going to have 40 too much, or there's a debit of 40 that needs to be credited. The second part of it, there was a discount allowed of 68, but it was entered as 86. So what has happened is that you minused 86, but in actual fact, you needed to minus 68 instead. So what's going to have to happen is that you would need to show that the problem is that this account has now suddenly got less than it should have. So what happened was it was then understated by the 86 minus 68. Now, interestingly, the difference between two numbers, wherever you transpose the two digits, the 6 and the 8 became the 8 and the 6. So if it was, for example, 53 became 35, anything like that, your answer is always going to be a multiple of 9. In this case, it's 18. So what has happened is that your account was overstated by 40, but then because too much discount was taken off, it was understated by 18. And so therefore the overall effect was that it was overstated by the difference of these two of 22, and therefore your answer is going to be A. Number 7. The trial balance totals are as follows. Debit $500,150 and credit $500,000. What error could have caused the difference? Well, the first thing that you want to do is you want to identify the fact that you have got a difference here of 150, and as you can see there's 150 more on the debit side, which means they made too much debit compared to what they should have. So let's look for something that would have that effect. A cash sale has only been recorded in the sales account. Well, if you've got a cash sale that has only been recorded in the sales account, your sales would have been credited where your bank should have been debited. So that would result you in a credit of $500, 150 rather than too much debit. So A is not going to be an option. B, a credit purchase has only been recorded in a supplier's account. Again, when you're buying on credit, if you credit a supplier's account, that means that you've forgotten the debit. And so your credit side would be bigger. That is not going to be a possibility here. C, a credit sale has not been recorded. If you don't have a credit sale in at all, and this goes for any transaction, if you don't record the transaction at all, your accounts would be incorrect, but your trial balance would still balance, because it just means that you've left out on the debit and the credit side. So C is not going to be an option. D, a credit sale has only been recorded in a customer's account. Now we're talking. What you would do is your customer's account needs to be debited, so we would have had a debit. And if we haven't done anything else, it means you've forgotten the credit. So D is certainly an option, and that's why the answer here is going to be D. Lastly, number 8. A business maintains a provision for doubtful debts of 5% per annum. It has trade receivables balances of $560,000 at the start and $468,000 at the end of the financial year. Which statements are correct? Again, let's not worry about what the options are. Let's first go and see what we agree with or not. If we maintain a provision of 5% per annum, and we have receivables of $560,000 at the beginning and $468,000 at the end, what we want to do is we want to have a look and see what would my provision be at the end and what would my provision be at the beginning. Well, quite simply, my beginning provision would be 560,000 times 5%, which is going to be 28,000. Nice shortcut for working that out is quite simply to say 560,000 times 10%, which is 56,000, and then divide by 2. And that's how I got my 28,000 so quickly. I bet before you could even pull your calculator out. You then work out what is your end balance at the end of the year. Your end provision would be 468,000 times 5%. We work it out in the same way. We say times 10%, which is 46,800, divide by 2, which gives me 23,400. So at the beginning of the year, I had 28,000 for my provision. At the end of the year, I want it to be 23,400, and therefore the difference is going to be 4,600. Okay, so the adjustment that I need to make is going to be a decrease of 4,600, which is the difference between those two, 28,000 minus 23,400. And that's the amount that would go into the statement of income. This one over here is the amount that I would have in my statement of financial position. Let's now have a look at the options that are given. 1. Customers' accounts have been credited with 4,600. Absolutely not. That 4,600 needs to be an adjustment in the statement of income. Number 1 is talking rubbish. 2. 4,600 is treated as an income in the income statement. Yes, that one is true, because where I'm going to decrease my provision, it means that it is going to be an income, and therefore number 2 is correct. Number 3, 4,600 is deducted from current assets in the statement of financial position. No. What's going to happen is it would be deducted from my provision to get from the 28,000 to 23,400 in my ledger, but then it's the 23,400 that would be deducted from the provision. So therefore, I only like answer 2, and therefore I like C, and that is the answer for that question. I hope this explains your assignment a little bit better. Thank you.